Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. In today's session, we are going to discuss a very important RBI notification, a very important direction that the RBI has recently released for the first time for the co-lending norms. Okay, so this is the direction that we are going to discuss and this is very important. So the Reserve Bank of India has released the co-lending arrangement norms or the directions for 2025. So what are these directions and what are the important data points that we have to understand? So all of this we are going to discuss in today's session. Okay, and this is a very important notification of the Reserve Bank of India that you cannot miss at all, and in today's session we are going to have the detailed understanding of this notification. Okay, so first of all, give me a thumbs up if I'm clearly audible and visible and everything is fine. So give me a thumbs up. Okay, so good morning everyone. Now, before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join the Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So let's get started with the co-lending arrangements directions 2025. So the Reserve Bank of India, the RBI has released the Reserve Bank of India co-lending arrangements directions 2025. So the regulated entities, they can enter into a lending arrangement with other regulated entities. So banks, they can get into the lending arrangement with the NBFCs and such for extension of credit to the borrower subject to compliance with the existing prudential regulations. So try to understand the brief idea that, let's say, the NBFCs, like recently the Flipkart has got the license for the NBFC that will be able to lend the money, but the NBFCs cannot take the deposit. Certain NBFCs, they cannot take the deposit. Like the Flipkart has got the license to become the NBFC that can provide the lending, but then Flipkart cannot take the deposit. Okay, so there are certain NBFCs that cannot take the deposit, but they can lend. Now these entities, they have limited money because they are not able to take the deposit, so they have limited money with themselves. Okay, so they can lend, but they have limited funds. Now these NBFCs, they have greater reach in the country because these NBFCs are established in different states, in different districts, in different like parts of the countries. Okay, while the banks, they are allowed to take the deposits from the public, all the banks can take the deposit from the country, and the commercial banks, they can also lend the money. But the banks, they have the presence but not in the far off part of the country. In certain parts of the country, the banks do not have as much reach. So you can understand that the NBFCs, they have the required reach, but they have the limited funds, while the banks, they have a lot of funds because they can take the deposits, but they have, in certain areas, they have limited reach. So the banks and NBFCs, sometimes they come together to provide the loan. Okay, so banks and NBFCs, they sometimes come together to provide the loan so that the NBFC's reach is taken like benefit of, as well as the bank's funds are taken benefit of. Okay, so they both come together to provide the loan or to service the loan or to cater to the loan. So regulated entities can enter into a lending arrangement with other regulated entities for extension of credit to the borrowers. Let's say there is a farmer XYZ in Maharashtra, in a village in Maharashtra. Okay, so now the NBFC, there is a certain NBFC that has reach in Maharashtra, that has reach in the far off areas of Maharashtra, but the bank does not have that much reach. Now this bank is saying that the bank and NBFC should come together so that the NBFC's reach and the NBFC's like direct connection with the customers can be utilized with the bank fund. Okay, the bank and the NBFC will come together to provide the loan to the farmers in the village areas in the Maharashtra region. So this is the idea that the NBFC's reach and the banking funds can come together to take care of the far off areas. This is the basic idea. I hope this is very much clear. That's why various entities, they come together to provide the loan. So regulated entities, they can enter into lending arrangement subject to compliance with the existing prudential regulations. Now what happens currently, that there are special arrangements or there are special guidelines that are released for certain projects or for certain areas, but there is no generic regulatory framework for such lending arrangements, co-lending involving banks and NBFC. So basically there is no generic regulatory framework for the co-lending or for the lending arrangement with other regulated entities. There was no generic regulatory framework. There were only specific frameworks that were released or specific guidelines that were released for certain projects or for certain areas. Okay, so there is no generic regulatory framework for such lending arrangements. Co-lending involving banks and NBFCs has gained traction or attention in the wake of a specific regulatory framework that was prescribed in 2020 for the purpose of priority sector. Like I have told you that there are certain guidelines or there is a certain regulatory framework for a particular area, but not the generic regulatory framework for the other co-lending arrangements. Okay, so there is no generic regulatory framework for the co-lending arrangements that is generic in nature, that is catering to all the co-lending arrangements. There is only certain specific regulations that are released. Like here you can see that co-lending arrangement regulations were released for banks and NBFCs for the priority sector lending only. So it was said that we also require the generic regulatory framework for the co-lending, because co-lending is also happening in different domains that is outside the priority sector lending criteria. Okay, so now the RBI has said that we are going to release a generic regulatory framework encompassing all the areas of co-lending. So even these priority sector guidelines that were released separately for the co-lending perspective, now these guidelines will vanish and now a generic co-lending direction has been released. This is the idea. So in view of this and to broaden the scope of co-lending, comprehensive revised directions on co-lending arrangements are now being issued with the objective of providing specific regulatory clarity on the permissibility of such arrangements, that where the co-lending arrangements are allowed, till what limit the co-lending arrangements are allowed. So all of this clarity has been provided, okay, while addressing some of the prudential as well as conduct related aspect. So in view of no generic regulatory framework available in the co-lending space, only a specific co-lending direction that is available in the priority sector lending, only this was available. There was no generic regulatory framework for co-lending. So now the RBI has released the comprehensive revised directions on the co-lending arrangements, that is encompassing the co-lending arrangements between the regulated entities. Okay, so this is the idea. Any confusion till now that why these directions have been released? Any confusion, anyone? I hope the general idea of the RBI co-lending arrangements directions 2025 is released is clear, that now why it is released, because there was no generic regulatory framework. So now RBI has released this comprehensive framework so that the regulated entities, they have the clear idea that what guidelines they have to follow when they are coming into the co-lending arrangement. Okay, so these directions are issued in exercise of the powers conferred by the Banking Regulation Act, the Reserve Bank of India Act, as well as the National Housing Bank Act. So as per the powers given by these acts to the RBI has provided these directions. Now these directions shall be called Reserve Bank of India Co-lending Arrangement Directions 2025. That is the broader guidelines that all the banks and NBFCs have to follow when they are coming into the co-lending arrangement for any purpose, for the priority sector lending or not. Okay, this is the idea. These directions shall come into force from January 1st, 2026 or from any earlier date as decided by the regulated entity through their internal policy, okay, but not later than this particular date. Existing co-lending arrangements, that is the lending arrangements executed before the date of the issuance of these directions. So these directions are released in August. So before August, any co-lending arrangement that is already in force, so and new co-lending arrangements entered into prior to the effective date of these directions shall be in compliance with the existing regulations or the earlier regulations. Earlier there were brief regulations that were released. So as per the earlier regulations, the norms should be followed. But from 1st January 2026, or let's say a bank has decided that from 10th November 2025, they are going to start following the directions. So from whatever date they have decided, from that date onwards, they have to start following the new directions, okay, but not later than 1 January 2026. This is the idea. Now coming to the applicability, which you know is very, very important from the examination perspective. But before understanding the applicability, there is a definition that the RBI has given for the co-lending arrangement. What is a co-lending arrangement? So actually, for the purpose of these directions particularly, the co-lending arrangement refer to an arrangement formalized through ex ante agreement. Ex ante agreement means that the agreement has already been prepared and has already been signed. Okay, so ex ante agreement between a regulated entity which is originating the loans. So there is a regulated entity, let's say it is a bank that is originating the loan, that is the originator of the loan, and another regulated entity which is co-lending. So one is the originator of the loan and the other entity is the co-lender, okay, is the co-lender. This is the idea. That is partner regulated entity. So one is the originating regulated entity that is originating the loan, and the another one is partner regulated entity. To jointly fund a portfolio of loans, let's say as we have discussed in the example that we are talking about Maharashtra. In Maharashtra there is a village, and in that village there are multiple farmers that want the loan. So NBFC has the reach in this area, and NBFC has the infrastructure in this area, and the bank wants to access this area, okay. So the bank and NBFC are coming together. The bank and NBFC are coming together to provide the funds, and the NBFC has the relevant reach in the region of Maharashtra, in this village of Maharashtra. So multiple farmers are getting the loan from the co-lending arrangement between the bank and NBFC. So this is the basic idea, okay. So basically to jointly fund the NBFC and the bank or the regulated entities, they are coming into the co-lending arrangement. They are signing the agreement that is already prepared to jointly fund a portfolio of loans comprising of either secured or unsecured loans. So it can be secured loan that has a collateral or unsecured loan that has no collateral. Sometimes the small loans, the microfinance loans, they do not have any collateral also, okay. So secured means collateral, the loan that has collateral. The unsecured loans means collateral free loans where there are no collateral in a pre-agreed proportion. So let's say the bank is saying that 80% of the funds will be provided by the bank, 20% of the funds will be provided by the NBFC, but NBFC will cater to other service requirements like taking the money or reaching out to the farmers, like telling them that they can take the loan from the bank and the NBFC. So this is the idea that NBFC will have the reach, but NBFC will only provide 20% of the funds, okay. So NBFC will have 20% of the risk and the returns also, and the rest will be with the bank. So the proportion is also decided beforehand, involving revenue and risks sharing also, okay, that in which proportion the bank is providing the fund, in which proportion the NBFC is providing the fund, as well as revenue and the risk sharing also. This is the idea of the co-lending arrangement, okay. Next is, now these directions shall be applicable to co-lending arrangements entered into by the following regulated entities: commercial banks excluding the small finance banks, local area banks and regional rural banks. So all the commercial banks excluding the SFBs, LABs and the RRPs, okay. Now all India financial institutions, that is NABARD, SIDBI, Exim Bank, NHB, NABFID, all banking financial companies including the housing finance companies. This is the idea. Now digital lending arrangements shall continue. Now digital lending arrangements, I hope you remember that we have discussed the digital lending directions. So the digital lending arrangements shall continue to be governed by the Reserve Bank of India Digital Lending Directions 2025, which we have already discussed, I guess, in April. So we have discussed the whole direction. So these directions will continue as amended from time to time, provided that any digital lending arrangement that is being followed, and in that, let's say in the digital lending space, there is co-lending that is happening. So all the rules and regulations of the digital lending arrangement has to be followed. After that, it has to be seen that the co-lending norms are also being followed or not, okay. So priority has to be given to the digital lending arrangement or the digital lending directions involving co-lending by the regulated entity shall without derogation to the digital lending directions be guided by the provision of these directions. Basically, it is said that you have to take care that if you are having a digital lending arrangement involving co-lending, so if you are doing the co-lending, you have to take care that the digital lending directions are being followed and the co-lending directions are also being followed. It's not like that you are following the co-lending directions, so you will forego, you will not care about the digital lending directions. No, you have to take care of all the directions that is there, okay. These directions shall not apply to loans sanctioned under multiple banking. Now see, there are different types of banking that happens. There is multiple banking, there is syndication, there is consortium lending, as well as there is co-lending, okay. Multiple lending or multiple, so there is multiple banking, consortium lending and syndication, okay. So basically multiple banking, it has like let's say I have taken the loan from State Bank of India, I have taken the loan from Punjab National Bank, I have taken the loan from SDFC Bank, I have taken the credit card from the ICICI Bank. So this is multiple banking, that from multiple banks I have taken the loan separately. That is very easy to understand. Now consortium lending means, let's say a big group of banks have come together to provide the loan for the infrastructure project. Okay, because let's say 1,000 crores are required by this infrastructure project. So a consortium lending is happening. A lot of banks and NBFCs and multiple lenders are coming together to provide the loan for the infrastructure project, for a very big project. Syndication lending, let's say there is a very big institute that requires the loan, okay, or like international loans are also like entangled here. So syndication means, let's say XYZ company or XYZ enterprise requires the loan. They are giving the responsibility to the syndication to get the loans for this company. So this is the syndication lending, or this is the syndication kind of thing, that there is a syndicate that is taking the loans or that is acquiring the loans for a particular enterprise. Now co-lending means that two institutions or there are regulated entities that are coming together to provide the loan to the different areas, to the different projects. This is the idea. This is the co-lending. So multiple banking means one borrower is taking loan from multiple banks or multiple institutions. Consortium means a consortium is being made. Multiple lenders are coming together to provide loan for the infrastructure projects and such. Syndication means a syndicate is being decided, that is acquiring the loan for a particular company or for an enterprise or for the international loans and such. Co-lending means there is an originator of the loan and there is a partner regulated entity that is providing the loan for the area, for a particular area and such. Okay, this is the idea. Now these directions shall not apply to loans sanctioned under the multiple banking consortium lending or syndication. This is the co-lending direction that should only follow for the co-lending arrangements. This is the idea. Save as otherwise permitted, in terms of these direction, no regulated entity shall enter into any co-lending arrangement without which is not compliant with these directions. So basically these directions has to be followed for all the co-lending arrangements. This is the basic idea. I hope this is very much clear. Now coming to the general guidelines, each regulated entity under a co-lending arrangement shall be required to retain a minimum 10% share of the individual loans in its book. So basically, if we are talking about bank and NBFC, that there is a bank and there is a NBFC. Bank is providing, let's say bank is providing 99% of the funds and NBFC is providing 1% of funds. Is it fair? The NBFC, will it have any interest in this kind of loan? No, the NBFC will not have much interest in this kind of loan. So it is said that at least 10% of the loans should be held in the co-lending arrangement. At least one entity, like one entity should hold at least 10% of the funds. Okay, so this is the idea. So this is the idea that each regulated entity in a co-lending arrangement shall be required to retain a minimum 10% share of the individual loans in its book, so that the entities, they have the respectable interest in the loans. Like you must have, if you have seen the Shark Tank and such, they say 0.1% of the equity or 1% of the share in the company, we don't want it because we will not have much interest to like build up your company and such. Okay, if we have 2%, 3%, 10% share in your company, then we will work for your company. Similar is the aspect here, that if the NBFC has very less share in the loans, they will not be interested in that kind of loan. They will let the loan be NPA and will not go after the loan. But if they have a respectable share in the loan, they will look after the loan. They will see that okay, the payments are coming back or not and such. Okay, so it is said that each entity in the co-lending arrangement should have a minimum share in the individual loans, at least 10%. This is the idea. Now the credit policy of a regulated entity shall suitably incorporate provisions related to co-lending arrangement. Okay, so basically regulated entity, if it is coming into the co-lending arrangement, it should have the credit policy regarding that. A bank should have a credit policy that has the provisions relating to the co-lending arrangement, including the internal limit or for the proportion of their lending portfolio. So basically, let's say a bank is giving 100 crores worth of loans for different areas, for different purposes. This is the loans that the bank is giving. Now, should the 100 crores of the loan should go under the co-lending arrangement? No. Let's say the bank has decided that only 10% of the total loans or only 20% of the total loans will go under the co-lending arrangement. The rest, 80% or 90% of the lending we will do separately, individually, okay, without the involvement of any other entity. Okay, so this is the idea that in the credit policy of the regulated entity, they have to decide the internal limit for the proportion of their lending portfolio under the co-lending arrangement. Target borrower segments, they have to decide that which borrower segment they want to target with the co-lending arrangement. Maybe they want to reach to the far off areas, maybe they want to reach to the farmers, maybe they want to reach for the allied activities and such. So target borrower segments that they want to reach through the co-lending arrangements. Due diligence of the partner entities. Let's say a bank is coming into co-lending arrangement with a NBFC. So they have to do the due diligence of the partner entity, that this partner entity is good or not. What is the financial condition of this partner entity? What is the track history of this partner entity? Has it been involved in some moral hazard, like let's say punishing or not being in good terms with the borrowers and such, like harassing the borrowers and such. So the due diligence of the partner entities has to be done so that it is seen that the arrangements are between good entities and such. Okay, customer service and grievance redressal mechanism, that how the complaints will be catered to, which entity will cater to the complaints. The agreement to be entered between the co-lending arrangement partners shall include detailed term and condition of the arrangement. The terms and condition, which entity will provide how much share, which entity will bring in the customers, which entity will service the loan, which entity will take the money and such. Okay, the criteria for selection of borrowers, that has to be decided through the co-lending arrangement. Specific product lines and areas of operation. Let's say the agricultural loans will be given, the loans to the MSMEs will be given. So product lines have to be decided under the co-lending arrangement. Fees payable for lending services. So there are various lending services. Lending service, now this is a definition that is given in the notification itself. So lending service shall refer to set of activities related to lending, such as customer acquisition. Usually the NBFCs, they have the reach, so they will be acquiring the customer. Underwriting means protecting the loan in a way. Pricing, servicing, monitoring, recovery of specific loan or loan portfolio, etc. So these are the lending services. Now let's say it is decided that the customer acquisition, underwriting, pricing, this will be done by the NBFC and the rest will be done by the bank. So the lending service that the different entities are providing, for that they will charge the fee also. NBFCs will say, if we are acquiring the customer, we will take this much fee. The bank will say, if we are servicing the loan, we will take this much fee. So fees payable for lending services has to be decided. If any provision related to segregation of responsibilities, who will be responsible for what? NBFCs will be responsible for what, and banks will be responsible for what. Time frame for exchanging the critical information. Let's say there are two banks. There is a bank and the NBFC that is doing the co-lending. Now the bank is getting the payments. It is decided that the bank will service the loan, the bank will take the payments, and bank will provide the relevant part to the NBFC. Okay, so bank is collecting the funds now. The bank is taking the repayment funds now. Now the bank has realized that okay, the borrower is not returning the money and it has been past the due date for the EMI. The borrower has not given the EMI now. So bank has to transfer this information to the NBFC also. So this is the idea that it has to be decided that within what timeline the information will be passed. Okay. Frame for exchanging the critical information. Customer interface. Customer will connect with which? The bank or NBFC. It's not like that the customer is calling the bank, the customer is also calling the NBFC. They are providing different information. Customer is getting confused. So this should not happen. So customer interface should be one only, either the bank or the NBFC. Okay. Customer protection issues and grievance redressal mechanism. It has to be decided that which entity will handle the grievances and the complaints. So loan agreement signed with the borrower shall make an upfront disclosure. So this was the agreement that is signed between the co-lending arrangement partners. They have to decide that who will provide which service, who will handle what. Okay. Now the loan agreement that is signed with the borrower shall make an upfront disclosure regarding the segregation of the roles and responsibilities. The NBFC will connect with you for signing the documents. The bank will connect with you for collecting the payments. So this has to be told to the borrower and specified to the borrower that sourcing, who will do the sourcing and who will do the servicing of concerned regulated entities, including clear identification of the entity being the single point of interface, that the bank will be single point of interface for the borrower or the NBFC will be single point of interface for the borrower. This has to be clarified, okay, to the borrower. As well as any subsequent change in customer interface shall be done after intimation to the borrower. Let's say the bank was the point of contact for the borrower, but it has been decided that the NBFC will now be the point of contact for the borrower. So when such change is happening, that has to be intimated to the borrower, okay, that now the bank will not be your point of contact, the NBFC will be your point of contact. This is the idea. The loan agreement shall also appropriately disclose suitable provisions related to customer protection, grievance redressal mechanism and such. So the different agreements have to be signed between the co-lending arrangement partners as well as the borrower and the entities, okay. All the required details of the co-lending arrangement shall be disclosed appropriately to the borrowers through the key fact statement, that is a statement which involves all the important information about the loan in a single page or in 1 or 2 pages. In brief, the information is provided to the borrower regarding the interest rate that is charged, additional fees that is charged, so annual percentage that is charged. So all the information has to be provided in the key fact statement. So the co-lending arrangement information also has to be provided in the key fact statement to the borrower, okay. Next is regulated entities engaging in the co-lending arrangement for loans eligible to be classified under priority sector lending. Let's say the bank is providing 70% of the funds and to the small and marginal farmers, and the NBFC is providing 30% of the funds. Now can we say that let's say 10 crores is provided to the small and marginal farmers through this funding? Can we say that the bank has provided 10 crores to the small and marginal farmers? No, they have only provided 70%. So only 7 crores will be considered, that 7 crores have been provided by the bank to the small and marginal farmers. So only this much will be considered under the priority sector lending. So basically the proportion that a bank is providing, only that will be considered under the priority sector lending, not the whole loan, because a part of the loan is being provided by the NBFC, okay. So I hope this is very much clear that regulated entity can only claim the priority sector status for the money that it has actually provided, not for the whole loan under the co-lending arrangement. Is this clear? Next is NBFCs shall adhere to the applicable accounting standards. Any confusion till now? Syndicate lending I will explain at the end. For now, kindly answer this. Is it clear? Everything is clear? So NBFCs shall adhere to the applicable accounting standards. See what happens, NBFCs might recognize profit before it is actually received in cash. So this is an example. That's called unrealized profit. Let's say the NBFC has given a loan in the co-lending arrangement for the tenure of 5 years, okay. Now interest income for the first year is booked upfront. That means interest income has been shown in the books upfront. It has not been received. It has just been shown in the books. So interest income for the first year is booked upfront, even though part of it hasn't been received. So right now is August. For December, there are nearly like 4-5 months that is still left. But for the whole year, the NBFC has already shown the interest, that this much interest will be received by the NBFC, and this is the unrealized profit. This is expected to be received by the NBFC, but it is unrealized because it has not been received till now. So NBFC shall adhere to the applicable accounting standards while booking of unrealized profit under co-lending arrangements. However, such profits can be shown in the books of the NBFCs, but such profits shall be deducted from the common equity tier 1 capital or net owned funds for meeting the regulatory capital adequacy requirement till the maturity of such loans. So basically it has been said that your unrealized profits, that is the expected profits that you are expecting, the interest income that you are going to receive in the future, you can show it in your books, but you have to deduct it from the common equity tier 1 capital, that is the most liquid kind of capital that the banks have to handle the distress, and you have to deduct the unrealized profits from your net owned fund also. Okay, so that there is not the double counting or the miscounting that is happening. Okay, this is the basic idea till the maturity of such loans, because the interest income is not profit if later on the loan becomes NPA. Okay, so this is the idea. Till the maturity of such loans, your unrealized profits has to be deducted from common equity tier 1 and net owned fund. This is the idea. Next is interest rate and the other fee and charges. So basically the final interest rate that is charged to the borrower shall be the blended interest rate. Let's say the banks, they charge 6% of the interest rate to the farmers, and the NBFCs, they charge 10% of the interest rate to the farmers. Okay, now the banks are providing, let's say 70% of the loan, and the NBFCs are providing 30% of the loan. Okay, so it has to be seen the interest. Now how the interest rate will be calculated for the borrowers, because the bank is charging different interest rate and the NBFCs are charging different interest rate. So basically it is said that for the total loan, let's say the total loan is of 1 crore to the farmers. Okay, so the total interest rate, that is also known as the blended final interest rate, the blended interest rate, the weight has to be taken. So the loan that is provided by the banks, let's say 70 lakhs that is provided by the banks, so 0.7 is the weight that has to be provided to the interest rate that is charged by the banks, and 0.3 is the weight that is provided to the interest rate that is charged by the NBFCs. Okay, so the weights will be provided to the interest rate that is charged by the different entities, and the blended interest rate will be taken. This is the idea. So final interest rate charged to the borrower shall be the blended interest rate, which is calculated as an average rate of interest derived from the interest rate charged by the entities as per the internal lending policies. As per the internal lending policies, the bank has different interest rate that they charge, the NBFCs have different interest rate that they charge. So average has to be taken on the basis of the weight, of the loan that each entity is providing. If the banks are providing more funds, the banking funds should be provided higher weight also. Okay, so this is the idea, that the final interest rate will be the blended interest rate, that will be the average of the interest rate charged by both the entities on the basis of the weight of the loan that each entity is providing. Okay, this is the idea. Now any change in rates by respective regulated entity under the co-lending arrangement will be made as per their credit policy. Let's say the bank are changing the interest rate from 6% to 8%. Let's say the farmers have got the loan on floating interest rate. So now in the market the interest rate is changing, and the bank has changed the interest rate from 6% to 8%. The NBFCs have changed the interest rate from 10% to 11%. Now this is a floating interest rate. Or let's say the interest rate have been decreased because of the repo rate that is decreased recently. Because of the decrease in repo rate, the interest rate is decreasing in the market for all the floating rate loans. So any change in rates by respective regulated entity under the co-lending arrangement will be made as per their credit policy and existing regulatory norms, and the same shall be reflected in the updated blended. Update has to happen on the blended rate and communicated to the borrower also, if the rate has been decreased or increased, whatever. Any fee or charges payable by the borrower in addition to the blended interest rate. Let's say the documentation charges that is paid, or the legal charges that is paid and such for the documents and such. So any additional fees or charges that is paid by the borrower shall be informed and shall be computed under the annual percentage rate, that is the final payment that the borrowers are providing. I hope you know about the APR. So annual percentage rate, this includes the interest rate plus the fees or charges that is paid by the borrower. So annual percentage rate is the actual cost of borrowing for you, because you are paying the interest rate on the monthly basis, on whatever basis you are paying the interest rate, and you are also giving some fees, charges for taking the loan, for documentation, for the legal purposes and such. So interest rate plus the fees and charges that you are paying for the borrowing, that is the annual percentage rate, that is the final rate that you are paying for borrowing. Okay, and this should be disclosed appropriately in the key fact statement, that is a one-page summary for your loan. Okay, now as part of the credit policy, the regulated entities also have to pay each other, right? So as part of the credit policy, the regulated entity shall lay down the objective criteria for fees or charges payable for lending services. Okay, like I am providing the customer acquisition, the bank is providing the servicing of the loan, I am providing the sourcing of the loan. So the regulated entity have to decide the fees and charges that they have to provide to each other also. So these are for the borrowers. Now this is for the regulated entity themselves, that as per their credit policy, the regulated entity shall lay down the objective criteria for fees or charges that will be payable or that will be charged for the lending services, depending upon relevant factors such as the nature of the service provided, quantum of the loan, like how much money, the sourcing, the servicing of the loan. Such fees or charges shall not involve directly or indirectly any element of credit enhancement or default loss guarantee unless permitted otherwise. What is credit enhancement and what is the default loss guarantee? Credit enhancement means a contractual arrangement in which a regulated entity provides some degree of added protection to other parties, to the other regulated entity, to a transaction to mitigate the risk for the other party. So bank wants that NBFC join the co-lending. The NBFC is not ready to join the co-lending. The bank is saying that do not worry, we will provide you the credit enhancement. We will protect you to certain extent. So NBFC will say, okay, this is a good deal for me, I will join because you are providing me the protection. So this is the idea. This is the credit enhancement, that is through the contractual agreement an entity provides some degree of added protection to other parties to a transaction to mitigate the credit risk of their acquired exposure. Default loss guarantee, this we have discussed again in the digital lending directions. Default loss guarantee is the contractual arrangement called by whatever name between the originating regulated entity. So originating regulated entity is, let's say, bank, the partner regulated entity is the NBFC, let's say, under which the originating regulated entity is providing the default loss guarantee to the participating regulated entity, and this default loss guarantee cannot be more than 5%. Okay. So this is the idea for loss due to default up to a certain percentage of the loan portfolio of the regulated entity specified upfront. Now this is the basic idea. Any confusion here? So basically originating regulated entity can provide the default loss guarantee to the partner regulated entity. Default loss guarantee, if the default happens, there is certain protection that is provided to the partner regulated entity. This is the idea. Now additional details, reporting to CICs, the reporting has to be done to the credit information companies, basic idea as per the existing regulations. Default loss guarantee. Now originating regulated entity can provide the default loss guarantee to the partner regulated entity up to the limit of 5%, up to 5% of the loans outstanding in respect of the loans under co-lending arrangement. This limit is as per the digital lending directions also. We have discussed in the digital lending directions that the default loss guarantee can be up to 5% only of the loans outstanding. Okay, and digital lending directions we have discussed in a previous session completely. Now next is asset classification norms. Very easy to understand. Basically, let's say the EMI payment should have happened on 5 August by the borrower. Now if the EMI payment has not happened on 5 August and the EMI payment is happening on 6th August. So what has happened? The loan has become NPA or what? Can anyone tell me that what is this loan categorized as now? Can anyone tell me? So basically this is SMA 1. Okay, this is SMA 1. Right? This has not become NPA. This is the SMA 1. Yes, this is the special mention account 1 in which it is said that okay, 5 August the EMI should have been paid on this date, but the EMI has not been paid on this date. Maybe something has happened to the borrower. So this is the special mention account 1. Okay. So now the NBFC is saying, because let's say the bank is collecting the funds. So the bank is saying that okay, this account has become SMA 1. Now this information has to be provided to the NBFC also, and the NBFC should also say that okay, this account has become SMA 1. Now try to understand that the bank has said that a loan has become NPA. The NBFC is saying that no, the loan is a standard loan, it is a good loan. So So this is incorrect information. This is not correct, right? So that's why it is said that asset classification norms are such that the bank and NBFCs, they have to be on the same line. If the bank is saying SMA1, the NBFC has to give the same information. If the bank is saying SMA2, the NBFC have to give the same information, or both the entities' information should collide, should be same, not different, okay? Okay, yes, SMA 0 for 30 days, okay? Yes, so asset classification norms, regulated entity shall apply a borrower level asset classification for their respective exposures to a borrower. Basically, if either of the regulated entity classifies its exposure to a borrower under co-lending arrangement as SMA, either the loan can be special mention in the special mention account or the non-performing asset. Both the regulated entities should provide the same information. It should not happen that one regulated entity is saying that it is a standard loan, the other is saying it is a NPA. That should not happen, okay? Next is that transfer of loan exposures. Any subsequent transfer, let's say that the regulated entity and the NBFC, they have come into the, like the bank and the NBFC, they have come into the co-lending arrangement. Now the NBFC is transferring its loans to some third party, okay? So any subsequent transfer of loan exposure originated under the co-lending arrangement to the third parties, or any interstate transfer of such loan exposure. Let's say the NBFC is saying that I do not want to hold on the loan for any longer. The NBFC can pass on the whole of the loan to the bank, okay? So basically, the NBFC is saying that, okay, I am not in a good condition, I cannot hold on to this loan. So let's say bank and NBFC, they have come into the co-lending arrangement, but NBFC cannot hold on the loan. So NBFC can pass the loan to the third party, to another NBFC, let's say, or the NBFC can pass on its 30% of the loan to the bank. Okay, so this is interstate transfer, that is inside the arrangement only the transfer is happening, the bank is taking over the 100% of the loan. This shall be strictly in compliance with the provisions of Master Direction Transfer of Loan Exposure. Such transfers to a third party, however, can be done only with the mutual consent of both the originating and the partner regulated entities. So basically, one of the partner or one of the entity in the co-lending arrangement can transfer the loan to the third party, or can transfer the exposure to the third party only with the permission of the other partner, or the partner of the loan can provide the loan, 100% of the loan to the other partner, okay? So transfer of loan can happen. Disclosures, so they should disclose prominently, the regulated entities, they have to prominently disclose their partners in the co-lending arrangement on their website, as well as the regulated entity shall also make appropriate disclosures in their financial statements under note to accounts relating to necessary details regarding the co-lending arrangement. So that has to be provided. The details may inter alia. So in the notes of accounts, the details has to be provided, such as the quantum of the co-lending arrangements, how many have been signed, for what amount they have been signed, weighted average rate of interest that is being charged, the fees charged or the paid and such. Now this is the last slide for today's news article. So the CLA shall entail an irrevocable commitment on the part of the partner regulated entity to take into its books on back-to-back basis as shares of the individual loan. So basically, they have to show, see, if I have provided a loan in the co-lending arrangement, I have to show it in my books, whatever amount I have provided, okay? So this is just theoretical in nature, just read it. The important information is, if the originating regulated entity, that is originating the loan, is unable to transfer the share of the exposure to the partner regulated entity under the CLA within 15 calendar days. Basically, the bank has 70% of the, 70% of the funds are being provided by the bank. So 70% of the exposure and the 70% of the right is with the bank, and 30% of the right is with the NBFC. Now, if the exposure is not transferred, the share of exposure is not transferred within 15 days, first of all, it should be transferred within 15 days. Within 15 days, the bank should transfer 30% of the exposure to the NBFC. So, originating regulated entity, that is originating the loan, has to transfer the share of the exposure to the partner regulated entity as per their share under this co-lending arrangement within 15 calendar days. For any reason, if the share has not been given within 15 days, so this shall remain on the books of the originating regulated entity and can be transferred to other eligible lenders only under the provision of the transfer of loan exposure. This is the idea. So within 15 days transfer it, otherwise you will have to take the help of some other master action to transfer the exposure. Regulated entities shall implement a business continuity plan to ensure uninterrupted service to their borrowers till repayment of the loans. In the event of termination, in the event the co-lending arrangement is terminated, in that case also the services should be provided to the borrower in the uninterrupted manner, in the same manner. Okay, like I have told you that the NBFC can leave its position and the NBFC can say, that okay, I do not want to continue with the loan, but still if the NBFC is providing some services to the previous borrower, so that should be provided uninterrupted. The bank can take over the services, but the services should be provided in the uninterrupted manner even if the co-lending arrangement is being cancelled out between the bank and the NBFC. Still the services to the borrower should not be interrupted. This is the basic idea. So this you can read, basic idea you have to remember. Now all transactions, the disbursement that is happening, the repayment that is happening between the regulated entities as well as with the borrower shall be routed through an escrow account, the third party account maintained with the bank, which could also be one of the regulated entities involved in the co-lending arrangement. That means the escrow account cannot be maintained with the NBFC, it can only be maintained with the bank, either the originating bank or let's say some other entity outside, but the disbursement and the repayment can only be done through the escrow account that is maintained with the bank. This is the idea. Okay, now any confusion anyone has till now? Any confusion? See the first question and ask if there is any confusion. Okay, syndication. So syndication, basically there is an agent bank. There is an agent bank that is involved, that is bringing together the different banks and lenders so that the loan can be provided to an enterprise or an entity. So this is syndication, that through an agent bank or multiple lenders. Here also multiple lenders are coming together to lend to this enterprise, but here there is also an agent that is involved on behalf of the enterprise. Okay, so this is syndication of loan. And this is usually in case of big loans and such. Any confusion anyone other than this now? Any other confusion? Okay, no, escrow account, was it a third party entity holding? It is not compulsory for the third party. Here it is written that which could also be one of the regulated entities involved in CLA. Either it has to be a third party. Okay, let's say there is a bank and NBFC that are coming into the co-lending arrangement. Either the bank will handle the escrow account, or the bank is saying that okay, I do not want to handle the escrow account, so some third party then will handle this escrow account, but that third party has to be some other bank. It cannot be NBFC. Okay, so it is said that the escrow account maintained with the bank, which could also be one of the regulated entity that is involved in the CLA if it is a bank. Okay, or which could also be one of the regulated entity involved in CLA. So if the regulated entity involved in the CLA can also be NBFC, I think. Okay, but if it is outside the CLA, so basically it is said that the escrow account can be handled by a bank, okay, which can also be the entity that is involved in the arrangement or some other third party bank. So this is the idea. So basically all transactions between the regulated entities as well as with the borrower shall be routed through an escrow account maintained with a bank, which could also, if the bank is involved in the co-lending arrangement, it can also maintain the escrow account. This is the basic idea. I hope this is clear now. Now this is the first question. I hope you will be easily able to answer this. See, usually in the, yes, they are somehow same, like somewhat they are same. Very small difference is about the agent bank. In the syndication, the agent bank is also involved. Okay. Now this is the second question. I hope you will be easily able to answer this question. Now before moving forward, there is a perspective 360-degree series that is provided by EduTap, where you are getting the descriptive answer writing practice. Okay, many of you always ask that, okay, how to do the descriptive answer writing, how to practice the questions. So here you can see that current affairs or the recent hot topics like the FDI, India's net FDI crashed, as well as Sustainable Development Report 2025, World Economic Outlook Report and such. So these current hot topics from which the questions can come in the examination. So they are discussed in the perspective 360 from the answer writing perspective, where you can know that what kind of questions can come for the answer writing or for the descriptive part of the examination, and you can also see that what are the questions and how you can write the answers. Okay, what can be the answers. So this is the series that you can utilize for your answer writing practice. A very good series taken by Jaskran sir on Monday, Wednesday and Friday at 5 p.m. And here you also get a homework question that you can write in the comment section below. That is also answered by the, that is also reviewed by the team, or the feedback is provided by the team for the answer that you are providing. Okay. So this is the idea. So this is the second question. I hope you will be easily able to answer the question. In here you have to tell that which of the following statement is incorrect. I will complete the question in the PDF that I will provide you, but basically you have to tell that which of the following statement is incorrect that you have to answer. Okay, so this is it. So the first statement, minimum 15% share of the individual loan in his book, then 5% is for the default loss guarantee. Then it is said that the NBFC shall adhere to the applicable accounting standards while booking of unrealized profit under CLAs that has to be deducted from CET1 and net own fund. So basically these are the three statements. Do tell me that which of the statement is incorrect. So this is it for today. Thank you everyone. Thank you for joining the session. If you have still any query, you can write in the